A man walks into a bank in 2019. He has a steady job, decent credit, and a plan. He wants to borrow $40,000 to start a small business. The loan officer smiles. The paperwork begins. 6 weeks later, he is approved. What nobody tells him, what the paperwork does not say, is that the bank did not actually have $40,000 sitting in a vault waiting for him. It created the money. Right then. When he signed. That is not a conspiracy theory. That is how modern banking works. And once you understand it, you will never look at a loan the same way again. Welcome to the American bank loan system. One of the most powerful, most misunderstood financial mechanisms in the world. And one that roughly 200 million Americans are currently participating in, mostly without reading the manual. So let us read it together. First, the basics. A bank loan is a legal agreement. You borrow a sum of money from a financial institution. You agree to repay it over time, with interest. Simple. But the architecture underneath that agreement is anything but. There are several major categories of bank loans in the United States. Personal loans, mortgage loans, auto loans, business loans, student loans, and lines of credit. Each one has its own rules, its own rate structure, and its own set of ways to cost you more than the sticker price suggests. Let us start with personal loans because they are the most common entry point. A personal loan is unsecured. That word matters. Unsecured means you did not put up any collateral. No house. No car. No asset the bank can seize if you stop paying. Because of that, the bank takes on more risk. And because the bank takes on more risk, you pay a higher interest rate. That is the logic. In 2024, the average interest rate on a personal loan in the United States was somewhere between 11 and 21% depending on your credit score. Someone with excellent credit might pay 11. Someone with fair credit might pay 21. That gap, 10 percentage points on the same product, is the price of being poor or financially unestablished in America. On a $10,000 loan at 11% over 3 years, you repay about $11,700. At 21%, you repay over $13,000. Same loan. Same bank. Different life circumstances. $1,500 difference. Gone. Now let us talk about what determines that rate. Your credit score. The FICO score, which ranges from 300 to 850, is the single most consequential 3-digit number in the financial life of an American. It is calculated based on 5 factors. Payment history, which counts for 35% of your score. Credit utilization, 30%. Length of credit history, 15%. New credit inquiries, 10%. And credit mix, 10%. Payment history is the biggest factor, which means the system rewards people who have already demonstrated they can handle debt. To get good credit, you need credit history. To get credit history, you need someone to give you credit first. It is a circular system, and it is designed that way. If you are young, or an immigrant, or simply someone who never needed to borrow before, you enter the system with no score. And no score is treated almost identically to a bad score. The irony is complete. The people who need loans most often qualify for the worst terms. The people who need them least get the best rates. Now here is where the mechanics get quietly extraordinary. When a bank approves your loan, it does not transfer money from a depositor's savings account to yours. It simply creates a new deposit in your name. This is called credit creation. The bank is not a middleman moving existing money around. It is a generator manufacturing new money on the basis of your promise to repay. The Federal Reserve calls this fractional reserve banking. Banks are required to hold only a fraction of deposits in reserve, historically 10%, though the Fed actually dropped reserve requirements to 0 in 2020. 0. Which means the theoretical limit on how much new money a bank can create from a single deposit is now essentially mathematical rather than regulatory. Your loan is not a gift from someone else's savings. It is a new claim on the future. Your future. Your labor. Your time. And the interest you pay is how the bank collects on that claim. That is part 1. The system is larger and stranger than most people realize. And in part 2, we follow the money to where it actually goes.
In the American loan system is quite as revealing as the 30-year mortgage. The median home price in early 2025 crossed $420,000. The average 30-year fixed rate sat around 7%. Run those numbers. You borrow $400,000. You repay $930,000. The bank collects $530,000 in interest alone. More than the value of the house itself. And you will call that house yours. Auto loans follow the same logic but faster. The average new car loan in 2024 was $40,000 at 7.5% over 68 months. Nearly 6 years of payments. And cars depreciate the entire time. By year 4, millions of Americans owe more on their car than it is worth. The industry calls this being underwater. Most people call it Tuesday. Now here is where the process gets personal. When you apply for any loan, the bank runs underwriting. They assess 5 things. Your income versus your existing debt. Your savings and assets. Your collateral. The economic conditions. And your credit history. Each one is a filter designed to protect the bank, not to serve you. 1 in 5 loan applications in America is denied. And those denials are not distributed equally. Black and Hispanic applicants are rejected at significantly higher rates than white applicants with similar credit profiles. This has been documented repeatedly by the Consumer Financial Protection Bureau. The algorithm reflects the history inside it. Then there are the features buried in the fine print. Prepayment penalties. Some loans charge you a fee for paying early. You are being penalized for being responsible. The bank built in a mechanism to collect interest it would otherwise lose if you became debt-free ahead of schedule. Balloon payments. Common in commercial loans. You make low monthly payments for years, and then a massive lump sum becomes due at the end. Miss it and you default on the entire loan. Not a warning. A clause. In the contract you already signed. The Consumer Financial Protection Bureau was created in 2011 specifically to police these practices. It has issued billions in fines and forced restitution. It has also been the repeated target of legislative efforts to defund and dismantle it. Draw your own conclusions about who benefits from weaker consumer protection. So here is where we land. The American bank loan system is not broken. It is working exactly as it was built to work. It transfers wealth from borrowers to institutions over long periods of time, using legal contracts, at interest rates that almost nobody fully calculates before signing. The average American household carries roughly $101,000 in total debt. Mortgage, car, student loan, credit card. That debt is generating returns for someone on the other side of the table. And that someone is not you. The question no loan officer will ever answer for you is this. If borrowing is the primary mechanism through which ordinary Americans access housing, education, transportation, and opportunity, and if every single one of those loans is structured to return more than it gives, at terms that punish the vulnerable and reward the already wealthy, then what exactly is being built here? Is it an economy designed to lift people? Or a system designed to keep them just solvent enough to keep paying?